Hello everyone, happy good day to you. Welcome back to Emoji Economics. So we shall still continue our discussion on national income accounting, but today we'll be talking about a question. We're addressing the question of national income accounting. Okay, so what is the question? In a simple economy, suppose that all incomes are either compensation of employees or profits. Suppose also that there are no indirect taxes. Calculate the GDP. Show that the expenditure approach and the income approach are equal. Okay? Now, we have these items: consumption, investment, depreciation, profit, exports, compensation of employees, government purchases, direct taxes, savings, and imports with their respective values. So, whenever we have a question like this, whenever we have a problem like this to address, the easiest thing to do is to first use the expenditure approach because it is so straightforward. Now, remember that the expenditure approach just talks about the aggregate spending on finally produced goods and services in a given year, like in the current year. So what are the components of the expenditure approach? We have consumption, aggregate consumption, we have gross private domestic investments, we have the government spending, then we have this section that represents the net export, which is exports minus imports. Okay, so now what is the consumption spending? From the question, consumption spending is 5,000 naira. The amounts are given in naira. 5,000, which is 5,000 plus what is the investment spending? So we have, let's go for investments. Consumption, we have investments, 1,000, fine. So we have 1,000 here. Now, what's our government spending? Government spending is, we have government purchases, which is 1,000. That's 1,000. Then plus, what is exports? So we have an export of 500. So 500, then minus, what is imports? 700. So exports is actually lesser than imports, which gives a negative value, a negative value for the net export. It's going to be a minus 200 at the end of the day. So by the time we sum this up, 5,000 plus 1,000 is 6,000, 7,000, then this is minus 200. What is this? Minus 200. So 7,000 minus 200 gives us 6,800. So it's as simple as that. So whatever we must get for the income approach also has to be equal to 6,800, since we have to prove that the expenditure approach is equal to the income approach. Even if that were not the case, even if we're not asked to prove, as long as we have the elements that we need to compute the income and expenditure approach, our answers are expected to be the same. And I think I explained that in the very first video of this particular session. Okay, so the income approach is all about summing up the incomes of the basic factors of production, the income that landowners receive, the income that capital owners receive, the income that laborers receive, and the income that the companies, the employers themselves, that they receive. So we sum them up as long as those incomes are meant for currently produced goods and services. So we sum them up, and at the end of the day, so what are the incomes? Remember that when we're talking about the income approach, we needed to add depreciation. So we add depreciation, which is 600. Then what else? We add profits, but I'm not going to add company profits yet because I want to explain something about it. So we have compensation of employees, which is 5,300. Okay, then we now have the profit. So the profit is 900. Then 900, if you see in the bracket, there's 900 minus 800. So why are we subtracting 800? We are subtracting 800, which is the direct taxes from the profit, because this profit is actually profit before tax. So if you are to put this profit, if you are to add this profit into the income approach, into obtaining the GDP from the income approach, and then we add taxes. Remember that government also has income, which is what they get from the taxes, whether direct or indirect taxes. So if we add profits and then we add direct taxes, so we are like adding taxes 2 times because we still have taxes inside this profit. So we have to, everything that we need is a basic understanding of what the question is talking about, or what national income is actually talking about. This same question could be tweaked in different questions. Okay, they could be divided into 2. Okay, where you have profits that will be a pre-tax profits, and in the other question there's going to be an after-tax profit, and your answers are not expected to be the same. So it depends on how you understand the concept. So if this were a pre-tax profit, you are going to subtract direct taxes from that pre-tax profit, because what we need is actually the pre-tax profit. Okay, that's one. And if this were an after-tax profit, that is profit after tax, there is no need to remove direct taxes from it anymore, because that is what we basically need. So direct taxes could be in the question, could be in the items of the question, but if the profits were after tax profits, you don't need to add the direct taxes anymore. So that is what we are talking about. So what else? So that's why we have plus 900 minus that direct taxes. So we have the we have company profit that's actually the profit after tax. Plus, what is now the government income? The government income is the direct tax in this case, because the question already states that there is no indirect tax, there are no direct taxes. So we just add plus 800. So by the time we do all of the additions, 600 plus 5,300 equals 5,900. Plus, there's a balance of 100 here. Okay, which is plus 100 is 6,000, and plus 800 is 6,800. So we've been able to obtain the GDP, which is 6,800, and we've been able to show that the expenditure approach is equal to the income approach. If you have any question, please do not hesitate at all to leave them in the comment section. Like our videos, subscribe to our channel, turn on notifications, and share with your friends. See you next time. Thank you so much.